Hi guys, hope everyone is having a good day. Today is the second day of the week for week 11. And today we're gonna be having a session on time series forecasting and portfolio optimization. I know that like time series forecasting is not a new thing for us. I think we have been doing it for some times now, but we will have some, like overviews about them just to refresh our memory from the past weeks. And we will also focus on portfolio optimization, what it means and how we can do that and so on. Yeah. Yeah, I think we can start. Let me share my screen. Can you see my screen, guys? Good. So as usual, if you have any question or if something is not clear or my voice is not clear or like anything, just make sure to uh, inform me. Yeah. So let's talk about time series forecasting. So we know what time series data means and we know what forecasting means. We have done it a lot of times over the past weeks, but for the sake of remembering them, and for this week, for you using them this week, we will have some refreshing memory. Uh, yeah. So financial data such as the one and stock data such as the one that you're gonna be working on for this week are like typically include timestamped metrics. It could be like daily price, volume, and so on. So having this time series data or having this, like time series type of timestamp data will help us a lot to analyze historical um, uh, uh, data of the analysis. So of course we can get this from the data source. We can get this data for especially for the stock data. We can get it from various sources, but for your case and for I think the past time we worked on stocks, we used Yahoo Finance, like Yahoo Finance. They have their API, and you can just request by using the ticker and the start and the end date that you want to get. So this will give us the aggregated daily asset values of the stock, or the ETF, or and the indices. So what it means is, so of course we know that the stock price changes, it can change within a minute, it can change within an hour, or so on and so on. But what you get from this API endpoints is the aggregated daily value. So you will get the high, the low, the opening and the closing. So you will get the price that was set during the start of the day, uh, the minimum and the maximum price for the stock for the entire day, and the price it had when the stock was closed or for the end of the day. So having this data will help us a lot to have, to help us forecast the future. It will help us inform, adjust our portfolios, of course. And it will give us an insight into the asset behavior. So we like the reason I stopped was I wanted to talk more about the portfolio adjustment when we reach that point. So of course, when we talk about time series data, we have three things, right? Like so the time series data can be classified into three components. So you can classify it into trend. So the trend means long directional change in the data. So it's not like it's not a daily thing or it's not a monthly thing, but a long-term directional change. So a long-term directional change could be in a 5-year term. If it is growing over the 5 years, it could have like some down and ups during the day or the week, but when you see overall, you can see that it's growing or declining and so on. So we call that a trend. Uh, for the seasonality, it's more like a trend, but for shorter terms, it could be for in 2 months or 3 months, like more repetitive things. So I think last time even we have used the example of jackets. So the use of jackets, you can see it being affected by the season, right? So you could take that as a seasonality thing. And the residual is just the rest of the things that's left when you take out the trend and the seasonality. So having this, knowing this, identifying these elements will help you to improve the model's accuracy, as each of them uh, could help for forecast the future differently. So for forecasting, we have a lot of ways to forecast, but the main ones are statistical. From the statistical models, we have ARIMA, and for seasonal data, we have SRIMA. So the S is just for seasonality. So it's just an addition of one parameter. Basically, it's just an extension of ARIMA. And from the deep learning models, we have LSTM, which is the long short-term memory. Good pack of forecast. I think you have also seen it earlier. But so the ARIMA is short for, so it's just use SRIMA. Yeah, for the LSTM, I think you have seen it, but it's just a neural network model that captures the long-term dependency and its effect for the data, like the price and so on. So let's talk about the ARIMA model, since that's one of the models that we're going to be using. So for the SRIMA, you just have to add the seasonality. So let's talk about the ARIMA, right? So for the ARIMA, you have to understand three parameters that you're going to be using to, when you train the model, when you work with the model, you have to understand them. So let's talk about them. Yeah, sorry. So for the P, so we have three parameters, main parameters, which is the P, D, and Q. So the P represents the autorecursive model order. So what it means is, if you want the model to learn from its previous value, we call it lag. How much of the data should it take a look at? So let's say you have, like, it's just like the sliding window, right? It's a sliding window principle. So if you have n number of points and you're at the n5 in the fifth row or the fifth data point, how many of the previous data points should it look at to predict the next one or the sixth one, right? So for instance, if you choose a value of 1 for the P, it's going to mean when it's on 5, it's also going to take a look at 4. So it's not only going to take a look at 5, the fifth number, the fifth data point, but it's also going to take a look at the 4th in order to predict the sixth one. And once it's predicted, and it's going to be it's going to go to the sixth one, it's going to look at the fifth and the sixth to predict the seventh one. So it's just the number of the previous value that the model is going to observe, right? So if you set it to 2 to predict the sixth value, it's going to take a look at the third and the fourth, plus the fifth one, right? So higher could help you capture more dependencies on the past values, but you have to be very careful not to overfit, because a very large number could result in overfitting, right? So yeah, that's the P, and for the D is just difference. So even if the model is for seasonal data, it sometimes could not be seasonal, right? So you have to remove that seasonality and make it stationary. So that's what the difference means. So the difference is going to be, so it's going to take a look at the difference between the current one and the previous one, and try to stabilize that mean, right? since it's going to take a look at the mean and the variance between the two, and if there is a like difference, it's going to stabilize that one. So zero means no differences or don't difference. So it means there is no stationary. There is no, so the data is stationary. There is no seasonality. If you choose one, it's going to take a look at the first difference, which means only the previous one, or the second difference is going to be the second one for two. And the last one, the Q is just moving average order. So it's just the number of lagged forecast error in the prediction equation. So should it also account for the noise that occurred in the previous data or not? So if you choose not to include the error from the previous one, you can do that. But if you want, you can also include it. So this will help you smooth out the noise by averaging over recent prediction errors. So these are the three things. So you can play around with them and get a better result. So how can you get the optimal parameters for training your model? So the first one, of course, which could be computational intensive, is grid search or manual iteration. So by using, of course, there is a library called AutoArima, which automates the process of searching, like the optimal PDQ values over your parameters. But of course, it's going to be a bit intensive. So it's going to test different combination of these three parameters and see their error to find the optimal one. So if the error is you're gonna go with the combination of the parameter with the lowest error. But it could take a lot of time. The second one is model evaluation with BIC, AIC. So this will help you compare the model performance. So if you get lower either BIC or AIC, it could mean that the balance quality of the model is simplicity. So trying to find the lowest AIC, BIC, and still avoiding overfitting is going to be your target here. And the last one is cross-validation, which means you're using some portion of the data that's not trained on the model, that's not used to train the model in order to validate it. Yeah, so I think we already know how to build and train our models. So the first one is to split your data and then train on the training data, and then select the parameter. Of course, you have to select the parameter by using grid search or other parameters. And of course, you have to evaluate the model and repeat this cycle until you get like an ideal or like a result that you are happy with. Yeah. So how can you use for insight? How can you use the forecast for insight so you can visualize the forecast in order to see what could happen in the future? You can have a confidence interval, like highlight the forecast uncertainty to manage risk and others, and interpret the trade and volatility. So if it is highly volatile, you should like inform in your portfolio strategy because it's going to have a lot of risks, and you have to see also the trend if it is going upward, like downward or stable. So you have to know that as well. Okay, so before we move on to the second part, which is portfolio optimization, is it clear? Is what we have discussed so far clear, guys? I just wanted to check up. So is it not clear? Am I audible? So it's clear. Okay, good. So let's move on to the portfolio optimization. So let's assume, so we have seen also in the challenge document You have seen it in the um, like in the business context or in the context that you have had like different types of like stocks that you want to invest in, but you want to have the best balance between the return and the risk, because we all know that high risk could give in high return, but like it could also result in high loss, right? So portfolio optimization is just for you to achieve the best balance between return and risk. So you still want to get some return, but how you want to do that with minimal uh, risk. Or yeah, of course you cannot avoid the risk at all, but having to minimize it is the best way. So you have three types of assets, as you have seen. You have the growth assets, which has high risk and high reward. So from these assets, like you can see Apple, like Nvidia, Tesla, and other assets have high risk but high reward because they are highly volatile. And you have bonds, which are backed by the government or other high institution, governmental institutions. So they are really stable and have very low risk, but of course it has very low income as well, or low reward. And we have ETFs, which are moderate risk. So still very short term, but they have moderate risk and more moderate return. uh, and so you have to choose to like how much percent. So if you have $100, how much of it do you want to invest in the growth stock? How much of it do you want to invest in the bond, and how much of it do you want to invest in the ETFs or other stocks? So that's what you're trying to find out or figure out, so that you will have very high risk, and you will still get some return. So why diversify your portfolio or your assets? So reducing this portfolio risk by spreading exposure across different asset class with different risk profiles is going to help you reduce your loss and still get some return. So before we go into the method, let's take a look at some key metrics that's going to help us identify or get to this portfolio optimization. So the first one is expected return. So the average return based on historical data. There is just the price fluctuation. So highly volatile means high risk. So if you cannot like if like today you see it $100 and tomorrow if it goes down to $90 and the day after tomorrow if it goes to 95, like you cannot last point, so it's highly volatile. And Sharp ratio is just risk adjusted return. It's useful to compare assets with different risk level. And value at risk is just the measure of maximum expected loss over a specific time frame and the confidence interval. So how do we adjust the portfolio? So the first one is, so we have the so set initial allocation across assets based on the risk tolerance and return goals. So like I've said, if you have $100, you have to give weights. So for the Apple, I'm going to invest this much. For the bond, I'm going to invest this much, and so on. So you're giving it, and then you're going to optimize the techniques. So use mathematical methods to adjust weights, aiming to maximize the. So your aim is going to be maximize a Sharp ratio and minimizing the volatility ratio. So if you increase the bond allocation, it's going to have uh, low volatility, but it's going to have very low, like return. But if you like decrease the weight allocation to the bond, it's going to have very high volatility, but the return is going to be high as well. So if so, like I said in the beginning, with the portfolio weighting, you have to have your return goals. So if your goal is to have high volatile, high volatility, you can increase the bond allocation to high growth bonds or stocks and so on. And then yeah, you have the forecasting guide adjustment. So by using this, you're gonna have an adjusted weighting to leverage the prediction, predicted strengths, enhancing your portfolio reliance and growth potential. So once you have the weights, you can use the forecasted model in order to see how much you're gonna make over the like the forecasted period. So for finding our optimal portfolio optimization, we're going to use efficient frontier, which is you set of optimal portfolios offering highest expected return for a given level of risk. So trade-off. So this basically means the trade-off between risk and return, capital allocation line, and capital market line. So for the risk measures, you have the variance or standard deviation, which is the total risk at value, the potential loss, or like the potential amount of money that you could lose over the period of time. Conditional value at risk, so expected loss exceeding the value at risk, and the Sharpe ratio, which is just risk adjusted performance. So lastly, using portfolio forecast for portfolio decisions. So it could be tactical asset allocation. So adjusting the weight based on the market forecast is going to help you get minimal, like minimal risk with a good return. Trend following. So you using the trend prediction to determine positioning size is also good. Pairs trading, exploiting the mean reversion in correlated assets, and section rotation. So shifting between sectors based on the economic sector is going to be is your portfolios. Yeah, so that's it from my side. Do you have any questions? Or is it clear? Before we move on to the practical side, I want to see if it is clear so far. Yes, Sanok. If you're speaking, you're on mute, or was that a mistake? Okay. Yes, Sanok.
Okay, thank you. I was trying to do some tasks from this project, and I have one question. The question is, are we going to give the trained model a date to predict the next volumes or prices, or how do we, or what kind of data we are going to give it for the prediction? In my work, I just give it X train and Y train, which is 80 and 20%. So it knows some values and it can predict the next. But it is forecasting. So how can it forecast for the next days or for the next 3 or 6 months? So summarize,
Of course, you have to
Raghav.
give it. So, yeah, I understand.
Uh,
So I understand your question. So you're saying that you gave it the data and it can forecast, but it's not giving you the date. Of course, it's not going to give you the date, but like for a year you have 248 days, right? Because like 448 trading days, of course, we have 365 days, but for the trading dates, these are the amount of dates. So you give it, for example, if you give it 5 years worth of date, and if you ask it to give you the forecast for the next, let's say, 30 days, or I think 6 months. So if you take it out the next, is that clear, or did you lose me?
Yes, yes, it is clear. Can I add one question?
Of course you can.
Okay. Uh, on task 2 and on task 3, it says predict only for Tesla asset or for the Tesla stock. After that, you can decide
Can you
on
repeat?
the
I'm
next
sorry.
two assets. Yes,
I
can you
think
hear
you were
me?
breaking up. I think you were breaking up.
Okay, I think it's my network. Can you hear me?
Yeah, I can, but can you repeat the question? I think. Oh, yeah.
Okay, on task 2 and on task 3, it says just predict for the Tesla stock, and finally you can optimize for the next two. So, what kind of approach we can use to assign other dividends for the next two stocks or assets?
The questions are clear. So you can train the model on one. So can you repeat? I'm sorry. Like the question is not clear for me.
Okay. Uh, the task is on predicting on Tesla
Okay. Yeah.
assets. Yes.
Okay.
Yes.
Yes.
After we predict on Tesla, uh, we recommend our user how many assets uh, to buy from the Tesla seat. Yes. Ella.
Assets. It's breaking
Yes, we
up
have
on my side.
multiple assets, but
Yes.
it was
So
given
so
for
the
Tesla on task 2 and 3.
yeah, for task 2 and 3, you can do that. Of course, you can recommend by looking at the by looking at the forecast for the next 2 months. It's recommended that you buy more assets or you sell your assets. So because depending on the forecast, if the forecast shows you that the price is going to go down, you could recommend the user or the buyer to sell their price their stock. But if it's going up, you can recommend them to buy more, right? So that's what
Yes,
you mean.
yes.
But yeah, so you can do that, of course. But for portfolio optimization is when you have multiple assets. I don't know if it's lost, but
Yes, I can
so
hear
can
you.
you?
Yes, I am here.
Okay, yeah, okay, good. So that, like I've said, it's for when you when you have different assets and you want to have the most optimal return from them. So we will see them. I
Okay,
think in the
okay.
example it could be more clear. Okay. Any other questions? Can you mute? Yeah. So any questions? Any other questions? If not, I think it's better to move to the slides, like the demo, so that we can more understand. easily
Error,
understand what we mean by, of
error.
course, for the right.
You hear
Yes,
me?
am I
Sorry.
breaking up? Yes,
Yeah, I'm sorry. I'm
yes,
sorry.
I
I
can.
dropped some questions from the message button. So, uh, have you seen
Yeah,
efficient
okay.
about efficient frontier? One of
Yeah, I'm just
all
seeing
right. Continue,
it.
continue.
So it's used. So that's what I was trying to explain. So I think it's better to see it in action, because for the frontier, by using frontier efficient frontier, you can find the optimal percentage or the optimal percentage of width allocation. So so let me change my network because it's breaking up on my side. Is it better now? Can you hear me better, Adisu?
Yes, yes, Gerard. Continue.
Okay, good, good. So the way that you use expected efficient frontier is so let's say you have multiple assets, right? So, and from those multiple assets, you want to invest so that you will get uh, a portfolio with minimal risk or volatility and high sharp or return, right? So the way that's going to help you is it's going to like take a look at their return and variance and so on, and try to allocate weights, different weights to them. And finally, it's going to give you a weight for minimum volatility and maximum sharp, so that you can find or you could allocate these weights to the portfolio or to the stocks and get the result that you want, which is minimal volatility and high or maximal sharp ratio. So I think if that's not clear, I think we can just take a look at the example and come back to it and see if it's still not clear. So is that okay, Adisu? Okay, good. Yeah, so let's take a look at it. So here I'm just importing the like the dependencies here, and here I'm just setting the plotting style. And here I'm going to work with Apple, Amazon, and AGG, which is a stock or a bond. And I'm going to be working on it for the 8 years, for 9 years, from 2015 up to 2024. So here I just downloaded the dataset, and you can see some example of it for the Apple. You can see for the AGG and from the Amazon, this is just their closing price. And here you can see there is no missing data. And I just did some EDA on them. Oh, so on the EDA part, I just find the returns by using the change between the previous one and the current one and plot them. And here you can see just the analyzed return from them. And here you can see their price trend. So here is the Amazon, here's the Apple, and here's the AGG. So for the governmental bonds or assets or stocks, you can see that there is no high return in them, but they are highly non-volatile or minimal volatile. So you can know that it's not going to change that much over the course of years. But here, if you see Amazon, it started here and it's sometime in 2023 or 2022, it was at its peak, but and then it's dropped to very low, and like it's highly volatile, and you cannot like manage it and or tell if it's going to go up or down and so on. And Apple, if you can see, it's still very high volatile, but it's better when you compare it with the Amazon one. So here you can also see the daily percentage change. Here you can see the amount of change it had in the day. So here Amazon still had the highest. Apple, of course, has some, of course, but it's not as bad as the Amazon one. And for the bond, you can see that it's almost stationary. So, and then I just went to the time series analysis and forecasting. So for the forecasting, I just did it for Apple as an example. So here I have calculated the asset price and the return. And I just checked the stationary. If it is stationary, I can use ARIMA, and if it is not stationary, I can use SARIMA or play with the D or the difference parameter of the ARIMA one. So here I just used the argumented different test in order to see if it is stationary or not. And then here we have the time series decomposition. So we have for the decomposition, I set it to 1 year, which is 252 days per year, trading days. And I just, after that, I prepare the data set for ARIMA. Here I used 90% of the data to train it, and then use the rest to test the data. Here, as an example, just as an example, I used starting values for PDQ 011, 101. Of course, normally we should use the auto ARIMA library in order to find this value, which I will share actually. And then I just train the model on ARIMA with the order or the parameter PDQ and fit it and use it to forecast the future. Here is just to calculate the mean average value and root mean error values. Yeah, and here's just for plotting it, and here's just to calculate the forecast. So this is what you have asked, I think, Henok. So you can see for the feature steps, you can identify or you can name how much of the data you want to see. So here I set it so 30 days, 30. So it's going to give me the forecast for the next 30 days. And I'm going to use the fitted model in order to do that. And here I'm going to plot it. So here you can see the test. So here the time series value is not stationary. And so this is for the price. And for the return, it's actually stationary. So you can see that p-value is above 0.5, but here it's below. So you can see that it's stationary. So I can use the return to use it on the model so that I can use the ARIMA because it's not seasonal, because I have identified it to be seasonal data. So this is just the result from the model. Here from the data, I can see that the mean average, the absolute error is 0.009. So I use the return. So this is a very high value. Don't think of it as a small value. And here for the roots mean square value, I have got 0.012. And here you can see the forecast. Actually, here this is actually not the forecast, but this is the I'm just trying to get the seasonal, the trend, and the residual from the model. So I'm just decomposing it, okay? So here I'm just decomposing. So this is the original data, and from this data, I can decompose the trend. You can see I can decompose the trend. So trend is just over a long period of time. I think for the decomposition, I think I have shown you the code here. So here I have decomposed it. So for the seasonal, you can see it's repeated over a short period of time, and for the residual, it's just the difference between the two. And for the forecast, you can see that it's actually a very bad result. So this is the actual result, return, but for the forecasted, you can see it's almost forecasted a straight line, which is a very bad model. So you have to play around with the parameters in order to get a better one. And for the forecast, so this is trying to forecast over the test. Okay, so I have like if you remember, I have used 90% to train, and the remaining 20% I reserved for testing. So this is on the test data. You can see it's very bad, and this is the forecast. So for the next 30 days, it's as forecasted that it's not going to change. But it's not going to be true because it's a very bad model. So you have to play around with the parameters. So yeah, so that's it. But I think I have also included one here by using LSTM. So for the LSTM, you can see that it's better. It's very much better than the ARIMA model. But of course, I'm going to give you the code for both so that you can play around with the parameters and see which one to use. So let's go to the efficient parameter, like portfolio optimization. So for the portfolio optimization, the first thing that I did was get the expected return, or I analyzed the returns. So MU means like the annualized return for the model, and convergence matrix is just to analyze the covariance matrix. And then I selected 1,000 portfolios. So what it means is the model is going to generate 1,000 random portfolios by assigning different weights to the assets. I have 3 assets, so it's going to give different weights for each asset, and it's going to create 1,000 portfolios with different assets or different weights to the assets. Okay. And then for the assets, I have given it the assets. So we're going to have 3 assets. And then for the weight, it's going to give it the weights. And for the return, it's going to calculate the return from the weights. And standard deviation and Sharpe ratio is going to calculate these things. So the returns we have seen, we can get from the weight and from the annualized return, and the standard deviation you can get it by calculating the standard deviation of the weights. Of course, it's not it's always attached. So at the end of the session, I'm gonna upload it to the drive so that you can find it there. So after that, what I did was I tried to find the minimum volatility weight and the maximum Sharpe portfolios. So from the 1,000 portfolios, random portfolios, I'm going to find the one with the minimum volatility and the one with the maximum Sharpe ratio. So here is what I did. So it's going to find the minimum and the Sharpe. So from the maximum, I'm going to find the maximum Sharpe ratio. And for the minimum volatility, I'm going to find the minimum standard deviation value. And it's going to have these random portfolio results. So this one is just calculating the minimum volatility ratios, portfolios, and the maximum Sharpe ratio portfolios. And it's going to compile them into a dictionary and return them. And this one is just going to, so I used efficient frontier here in order to do that. But here I'm just, the second cell is going to plot this efficient frontier and the portfolios. So here, I think, I don't know how I can, okay. So here you can see the minimum volatility ratio is here because AGG is the minimum volatile. So it's going to give a lot of weight for the AGG and very minimum weight for the rest of the stocks. And here is the maximum Sharpe ratio volatility. And here is the Apple and the Amazon. So here you can see for the minimum volatility, since AGG is a bond, it is very less volatile than the rest. So it's going to give 97.9, almost 98% share or weight to the that stock. And for the rest, it's going to give them just 2% stock weight ratio. For the maximum Sharpe ratio, of course, you can see it's very much distributed. So depending on your metrics or your need, if you need minimum volatility, you can take this. If you need maximum Sharpe ratio, you can take this one as well, and so on. So you have to find the balance between that two. I think, yeah. So here you can see the expected return, the expected volatility, and like the Sharpe ratio. So for the minimum volatile portfolio, you can see the expected return is very low because it's minimum volatile, but the expected volatility is very low as well because it's 5.2%, but the Sharpe ratio is also very low. And the asset from the asset distribution, you can see how it has allocated them. But for the maximum Sharpe ratio, of course, you're gonna have very high return for, of course, depending or as comparison with the previous one, and you're gonna have a moderate or high volatility ratio, but the Sharpe ratio is going to be the maximum one, and the asset allocation, you can see it's very expanded. So it's better to go with the second one if you need to have some return or have yeah, have maximum maximum Sharpe ratio. Sharpe ratio. So yeah, this is just the same graph, but with a different method. Here I have used the efficient frontier in order to do that. So I use the same mu and s, and this is the result from the frontier. And you can see it's the same. And this one is going to give you the optimized portfolio weights instead of just saying this is for the minimum Sharpe ratio or the maximum Sharpe ratio, this is for the minimum volatility ratio, and so on. It's going to give you the exact result. Yeah, so that's it from my side. Do you have any questions? I think Adisu Tadele, is it clear now how you can use the library in order to get
Yeah, it's very clear. But
optimized?
I have a question.
Okay.
Calculating covariance matrix. Is it depending on the
Mm.
price of asset or a return of asset?
On the return, I think.
I think. All right.
You can see it here. Yeah. Okay. Any other questions? Good question. Thank you for asking that, Disu. So I'm going to use the annualized return. Okay. For the return, it's the annualized return. So any quick questions? Anything that's not clear? Okay. Yes, Enoch.
Okay, you used return as a target value, and on our case, it should be the close value, yes?
Not should. It's not a should thing.
Uh,
Of course, it's better to use the closed, but if you want to see the return value, so here I didn't talk about like the closing price. I'm not more or so like interested in the closing price. I'm not interested in finding out the closing price is going to have in the next 2 days, 2 years or so. I want to know my return, right? So since I'm more interested in finding out the return, I use the return. If you want to use the closing, so the only difference between the closing and the return is just the difference between the two consecutive closing dates, right? So you can, for the forecasting, you can identify the closing by using the closing. You can identify like the next, like for the next 30 days, what's going to be the closing price, and then from that price you can find the return. So it's not, you can do that as well. Okay. Yeah, okay. So any questions, anything that's not clear, please ask. Not, I think we can end the session here. So is it clear? Okay, good. Thank you. Thank you for joining, everyone. Let me just stop the recording.